Single stock futures were first suggested in the late 1960s to the U.S. Securities and Exchange Commission by often forgotten market innovator Murray Borowitz, executive chairman of the International Commercial Exchange. He was turned down. It was not until the idea for stock index futures was flowering in the early 1980s that single stock futures surfaced again before Washington regulators.
I go to visit Dow Jones. I have a conversation with a person who shall remain nameless, and he says, there's no way I'm going to allow you to sully my name with speculators. This is not something, the Dow Jones Index. We are not part of a commodity, and we don't want to be viewed like a commodity. I said, Mr. So-and-so, in all due respect, that's the point of this. Equities will become an asset class and they will be commoditized, and you don't want to miss this. And basically, he wasn't interested and said no. Les wanted to push on, who was a bulldog, as did the board at that time. And they said, let's list it without an agreement with Dow Jones. The board voted to do that, and Les got everybody's support, and we filed to list it, and it went to saying, look, this is like Bayer aspirin. Bayer didn't, basically, as a student of inventive activities, Bayer didn't manage to coin the word aspirin, and it became ubiquitous. And the argument is, when people say, how's the market doing, they mean the Dow Jones, and it is like aspirin. We lose the course, and then it goes to appeal, and the Board of Trade loses 3-2.
While the Board of Trade was stuck in court fighting Dow Jones, the competition didn't wait. Kansas City launched the Value Line Index on February 24, 1982. The CME launched the S&P 500 on April 21, 1982. And the New York Futures Exchange launched NYSE Composite Futures on May 6, 1982. To fight back, the Board of Trade pivoted.
Committee gets together. There's enough room in the appeal to be able to create a variant of the Dow Jones. So instead of being 1,000, maybe you make it 10 times the Dow Jones. There was enough room, as long as you didn't call it the Dow Jones, to create an exact Dow Jones duplicate. I said, let's build a sequence of ETFs. Let's build 5 names in a particular sector. So we would have a future on oil, and it would be Exxon and Chevron and et cetera. Then let's build it on semiconductors and have all of the images. Then let's just build it on retailing. And you would have derived liquidity because you had 5 underlying names. There would be arbitrage, and you would create a low-cost way of building a sector-based futures market. So let's take it down from this macro-level index to industry sectors, and let's go to the CFTC.
But the SEC said, whoa. This turf war led directly to the Shad-Johnson Accord. The SEC took control of narrow indices, the CFTC took broad indices, and single stock futures were banned outright.
I get a call from guys who are in the private equity business through Les, and from some guys at Battery, and they said, we would like to get into the exchange space. They said, what do you think the thing to do is? And I said, you're messing around here. I think what we ought to do is just buy the Merck. Battery, Les, and I went in and made a presentation to buy the Merck. They, of course, said no. We gave them a very good price based on seat sales and all of that. Then we tried to buy the Board of Trade, and couldn't get anywhere buying the Board of Trade. I had been working simultaneously with Brian Williamson, and he had been asked by the Bank of England to make sure that life stay afloat. He called on me to join this committee that was advising the Bank of England. I said, sure, happy to do it. Went over having some meetings. And then after no's from the CME and no's from the Board of Trade, I said, let's talk to Brian. And I, as an advisor, to try to buy the Life, which we did. I went on the board of Life, representing Blackstone, and Scott Tobin, who's now the managing partner, went on the board of Life to represent the investors. Among the discussions we had was, I said, you really need to develop some new products, and why don't you have your team look at single stock futures, because I think that this could be a huge winner. You don't have the SEC.
While Doc was helping build single stock futures competition overseas, Congress and U.S. regulators were starting to pay attention.
I was involved in helping to lift the ban on the Shad-Johnson prohibition against single stock futures when I worked in the Senate back in the late 90s. And we issued a GAO study when I was working for Chairman Lugar on the Senate Agriculture Committee to look at whether it still made sense to ban these products or not. And GAO's recommendation was these products are, being traded around the world. There is a way and a mechanism through a regulatory structure to allow these products to be traded in the United States. At the time, the U.S. was losing ground internationally, our futures markets. In 1999, Deutsche Börse became the largest exchange in the world by volume. And so there was real fear that we were losing competitiveness in the United States. This made logical sense as how can we give U.S. futures exchanges the tools they need to succeed? And this was a logical no-brainer one for us to do. And so that began the process of us legislating in this area, and ultimately the regulations that came into effect after the Commodity Futures and Modernization Act was passed in 2000, with a couple exchanges being launched. Life was offering single stock futures at the time. I was working in the Senate. I remember writing what they called a Dear Colleague letter, and that's a letter that a senator sends to all his Senate colleagues and asks for their support. And I remember in the subject line calling it "The British are coming." We had concerns that Life was going to take over this business that U.S. exchanges were prohibited from doing. And it seemed silly to me that, especially in our very global markets, that some parts of our markets had access to these products and others didn't. This was more of a question of two regulators across town from each other not being able to get along. And that did not seem like good public policy, smart government, to have that to be the reason that U.S. exchanges were not competitive.
Congress wanted to lift the ban on single stock futures to keep America competitive. But the pushback wasn't just coming from rival regulators. The traditional U.S. exchanges were terrified of losing their turf, and they took the fight to Washington.
Of course, we were vehemently against it because we saw it as a direct head-on competitive threat, which I think for a while it probably was. I testified against it, really just pointed out the similarities in the market and, the need to have some consistency in how regulators looked at it. We had a lobbying effort. We had a Washington representative. We made as much noise about it as possible. And when you were talking about, off-exchange futures or swaps, plain vanilla copies, it really was mostly affecting the energy industry. I don't think there was a lot of off-exchange trading in agricultural products or stock indices. And so while they might have had intellectual opposition to somebody being able to copy a futures contract and trade it without it being cleared and without it being federally regulated, we actually had, a tremendous impact on our business and the energy markets business. So I think it was necessary to include us.
Despite the massive lobbying effort from legacy exchanges to protect their moats, the government finally moved forward. In December 2000, Congress shocked the industry.
The spark for the single stock futures would have come out in the compromise of the Commodity Futures Modernization Act, right, in December of 2000. I think everyone was betting against that would be passed. And I think much to everyone's surprise, it was passed, right? So it was a little bit of a shock in December of 2000 that a law had been signed that was allowing for these single stock futures. There was a lot of question marks around the swap market, right? So that CFMA gave legal certainty to the swaps. That was the other dimension. So the quid pro quo was, hey, we have legal certainty on swaps, and we'll throw a bone to the futures world where they can start trading single stock futures, but it's got to be harmonious with the SEC. So the CFTC and the SEC both are regulating it, which some people were questioning, how long that would take to kind of harmonize.
In December 2000, Congress finally acted, legalizing single stock futures to keep U.S. markets competitive. But there was a catch.
With the benefit of hindsight, we were fighting over table scraps in a staggeringly large marketplace where our little corner wasn't getting traction. You had a securities lending industry that was just flat out opposed. You're not going to have a substitution value for my product.
Yeah.
It just didn't get the legs under it that it could have. I think there was also a stretch of time where we got caught up in contract specifications. Now, you rattled it off from nano up. The spectrum of different size contracts to meet different appetites is limitless now. At the time, when you've got limited turnover, do you turn around and slice your product ever more finely and so doing squander what liquidity you have? But we had some people that wanted smaller contracts. We also had people that wanted bigger contracts, and we got caught in the not good enough for anyone.
While single stock futures were working abroad, they were struggling in the U.S. But why?
Simply because of dual regulation. I don't think they have to be dual regulated given the difference in the roles of the CFTC and the SEC. And if we go back to the fundamental purpose of the CFTC and what futures are as risk transfer mechanisms and price discovery, not as a place to make and take delivery as their primary function, and look at securities, I don't know why there's a need to dually regulate. The role of margins, I think, are particularly an example of that. Margin is a debt. It is a borrowing against a security and is actually a loan, and it is a way to control leverage. Margin in a futures contract, as you well know, is a performance bond, and it's meant to be set low to reduce the cost of hedging and transferring the price risk. So they have two very different roles. And the whole difference between the markets is you're trying to say, well, I think a Great Dane's a horse, and let's just regulate it because it's got 4 legs and treat it as if it was a horse. And I just never understood the logic of that. And given that these are two regulatory agencies, they should not be competitive. They should be complementary, in my humble future. They should work for the satisfaction of the public in harmony.
When Nasdaq hired Bob Greifeld as CEO, he conducted an analysis of all the firm's businesses, including its single stock futures exchange, Nasdaq-LIFFE.
We were summoned to Greifeld's office, and Greifeld said to us, "You've got 5 minutes to tell me why you should live."
Single stock futures failed to catch on in the early 2000s, but now the CME Group is trying again. So why will it work this time?
Launching this as a new product line at the behemoth that is CME is a very, very different proposition. And what it's going to have to do to prove its own in what's already a wildly more favorable environment with a massive retail market, a massive institutional market, and a fundamentally altered risk appetite from the collective marketplace, the whole addressable market. It's a much lower hurdle to clear with a whole lot more rocket fuel available.
There has been some changes in the margining of these products, and that came in late, I think, 2018, 2019 timeframe. So some of the margin concerns have been addressed. Some of the structure is still there that needs to be addressed. FI has taken it on itself to try to identify where those burdens are. So our long compliance community is coming together to come up with a list of issues of where there are regulatory burdens that may not be necessary, or are there other ways to do it to capture what regulators need. We're also in discussions with the NFA and FINRA, and they're the frontline regulators on some of this, to make sure that their rules are properly calibrated for these markets. So CME, in deciding to go for this, I think has triggered a real life way our community to come together to say, how can we make this better? How can we still get the information the regulators need, but not so burdensome that it's gonna kill the product. So we are working with our members to see if we can figure out where that line is, and hopefully this product has a better chance of succeeding 2026.